Okay, we're going to talk about actually a trading system which inspired MTP or Market Timing Pro, and that is Richard Dennis and William Eckhart's trading system. So if you don't know what this story is, by the way, this is the number one book that I recommend if you're getting into trading or if you're a trader. And the reason why is this tells the story of the most successful mentor. So if you're looking for a mentor, it should be probably these guys or someone who's a student of them. I'm a student of these guys. You probably call it a third, fourth, fifth generation turtle, but I'm similar. Now, if you got into trading, I recommended you start by reading Market Wizards, because that gives you a big sample of what trading is and the different people and the different stories. Now, I'm not going to say it's that important. The world has changed. Those books are old. There's a lot of pit traders, which isn't really a thing anymore. It's not a thing anymore. And for me, it just led to this book and these guys. I like this book just because it's the most succinct version and it has the system in here. So I'm going to get into the trading system in a moment, and I'm going to talk about our system, MTP. And I'll talk about the legacy of Richard Dennis, but you need to know the story a little bit. So Richard Dennis, I believe, is the highest score ever. He turned $400 into about $200 million. He averaged 100% annual returns for 19 years. I don't think anyone has beaten that. He was a high-risk trader, and he had many 50% drawdowns. Now, he and his partner, William Eckhart, together trained a group of non-traders who were smart, but they were non-traders. They didn't have trading experience. They gave them 2 weeks of training. That training included giving them a technical system to follow. They would trade it manually, but it was technical and it was historically back-tested and proven to have edge. And they immediately averaged 100% annual returns as a group for 5 years. Now, there is some criticism saying that they risked too much, whatever, but as far as most people don't succeed in trading, for an entire group of people to dominate, it's an incredible story. There's no other story like this, and it goes to show you that your mentor really matters. I'm here to try to help you in that mentorship as a student of these guys and their lessons, but you should go straight to the source and learn from them, okay? Now, before I get to the system, it's important to know that this system is so successful that variations of it are the main systems traded by hedge funds today that are the largest capital in the world is run on similar systems to this one I'm going to explain to you. You can look this up and it's true. And understanding that also tells you could join them, and also beating them understands the metagame and how these guys trade. Okay, so let's get into it. Now this book, it's a lot about story, but here on page 67, it goes over the rules. So let's go over the rules. The rules, okay. We have a pretty strict definition of a systematic trader. They basically follow a set series of rules established in a computer program that tell you when to buy or sell, how many, as well as when to get out. By the way, if it sounds boring to you, like you're a robot, well, in 2025, it's easy to automate these things, but you have to ask yourself if you're here to trade or here to gamble. Trading is all about making money and nothing about spending time. Gambling is all about spending time and nothing about making money. So if you want to spend time trading, you're here to gamble, you're not ready for this. Okay. Errors, type 1 error is an error, a false negative. Rejecting something, not doing something you should have. Error 2 is doing something you should not have. So those are common errors. Here it's talking about edge. Okay, now entries and exits. So they had two systems. They would only do breakouts and breakdowns. I think it also talks about assets in here. So the first system is if something makes a 55-day high, you buy. If something makes a 55-day low, you sell. So that's the first trigger. If the price is the highest it's been in 55 days, you buy. Some of you guys might say, buying at a high price doesn't make sense. Well, when things are, they call it trend following system, but the idea is that the world changes. And when something's going up, it continues to go up generally, which is often true. If something goes down, it continues to go down. So they're not buying dips, they're only buying breakouts. 55-day highs. Okay. So, okay. System 2, say they had 2 systems and they're given some discretion in trading system 1 or system 2. So system 2 was the 55-day breakout or breakdown. System 1 is a 28-day price breakout. Or system 2, you exit if price makes a 14-day low. Okay, so this is pretty simple stuff. 28-day high, you buy. So here's the crazy thing is you're always buying a high price and you're always selling a low price. So how do you make money? Well, in theory, if you buy a 28-day high, it might keep going for months, and then the 14-day low is way higher than you bought. But it's trying to survive a really long trend. And I found this to be true. I'm going to talk a little about our system, MTP. They were trading in the 70s and 80s this way. This experiment was from the 80s, actually. So 40 years later, there's a lot more noise. And I think you need to be even more long-term, which I'm going to talk about. But they're doing breakouts and breakdowns. So, and there's some combination. So if they if they didn't buy the 28-day breakout, they'd buy the 55-day breakout. Now they have a filter here. This is a really interesting filter. It doesn't explain why. But if you're trading a 4-week breakout, if the last 4-week breakout was successful trade, you do not take this one. So if the last breakout worked, you don't trade the next breakout. If the last breakout failed, you do trade the next breakout. So it doesn't say exactly what it means for it to fail, but I guess closed at a loss versus closed in profit. So the point is, yeah, there's really interesting filters. And for our system, MTP, we don't have that filter, but we have certain filters. So I'm looking at something different. We look at something different because I want to do something different because you don't want to be the same. So a different plan, the same thing. MTP, our system, we're not looking at 55-day highs. We're also not looking at 28-day highs. We're looking at old calendar highs and lows. We dip by, but like the high of July, the high of August, the high of September. I like these because it's different. Fewer people look at them. But we need certain filters to prevent from, say it's like September 1st and you just crossed the high from August 31st, which is the high. It's not really a breakout. So we have certain filters where it needs to be an old calendar high between 20 and 200 days old. So, I mean, it's for reasons of making sense. If it's like way too old, it doesn't make sense. Okay, so they trade systems 1 and 2. Okay. Okay. System 1 and system 2. Okay, this is where I started to learn about robustness. If you guys listen to my videos, I talk about robustness a lot. So Jerry Parker uses robustness as his guiding precept. I think it's important to stay fairly simple, not a lot of variables. I think the reason we make money, it's the simple moving average systems. They need to continue to do well. The market gurus who pretend that a complex approach must be used to make money miss Parker's point about keeping it simple. They want the equivalent of quantum physics for trading rules. That kind of thinking is mental masturbation, or as trader Ed Psychoto calls it, masturbation. Okay, where does it say it? There's something good here. They were saying for robustness, if you change... Yeah, okay. A minor change of a variable in any robust trading system should not cause significant performance changes. If it does, you are in trouble. By the way, if you do read Market Wizards, one of the best chapters is William Eckhart. Richard Dennis is the more famous one. William Eckhart is the system guy. It's a really fascinating chapter, one of the most interesting. I remember at first I was like, I can't read this is boring, but as I got through it was like the deepest one. But so robustness for MTP is where a lot of people go wrong is they're trying to create the best system for the backtest, I'm not trying to create the best backtest. I'm trying to create a system that works on a number of assets and time frames. That's why I want the same trading system to work on gold, Bitcoin, NASDAQ. These are 3 different asset classes, right? Precious metals, crypto, and stock market indices. I want to be able to change the asset and it still makes money, right? I want to be able to change the asset and it still makes money. I want to be able to change the time frame. Start at 2020, start at 2017, start at 1983, still makes money. That's the robustness. So we haven't really talked about stop loss and position sizing. Okay. They're talking about here about how they held on. There's pictures in here too. You can see they bought at this 55-day high and price just went up to the moon, even though it pulled back quite a bit first. Okay. They held forever. I used to say we take a small loss, but I think it's better to take an optimal loss. You don't want to take one that's too large and you don't want to have your stop so close that you're going to get bounced out. Just hang on the trade. Don't get too excited. If you're not making that much money, it's fine. If you get a little loss, it's fine. If you make a decent profit that turns into a loss, that's fine. Just hold on to it and then get aggressive when you've been rewarded by a big, huge profit. Random entries. Here they're talking about the entry doesn't really matter, and I actually find this to be somewhat true. What matters a lot more is the liquidations. What are the liquidations? It's the conditional closes. So they have a conditional close of price makes a 14-day low. We don't have that. One of my conditional closes, though, is if price hits an old calendar high and then closes under it within the next couple days. That's a conditional close. But he's saying the conditional closes matter and the stops matter a lot more than the entries. You can have a random entry system and make money. And I find that and believe that to be true. Okay. Position sizing, where is it? Okay, they're talking about ATR. This is where I learned about ATR. So much of MTP came from this. So they used 15 period ATR. So I like 10. I also like 100. But average true range is the average volatility. So you take the 15 days, measure the average range volatility, and that's 1 unit of ATR or volatility. So I'll talk about our stops in a little bit. So they use that to measure 1 ATR unit, and they set their stop loss at 2 ATR. So their stop was twice the average of the last 15 days. Now, so they used a 2 ATR stop. You know, this is really interesting. I think this worked back in the day, but it doesn't anymore. When I'm testing, a 5-day ATR stop works much better, which is crazy because it's so wide. It's crazy wide. But I think there's more and more market noise now, even on a lower time frame, even on a higher time frame, that having a wide stop that you can stay with is really powerful and potent. So 2 ATR, it just doesn't work as well. And I know this from my computer backtesting. We were running 3.4 ATR for a while, 3.5. But it 5 works really good. So, but I like to look at either the last 10 days or the last 100 days, depending on the asset. Okay. So pyramiding, they pyramid. We pyramid too. Pyramiding is dollar cost averaging when things move in your favor. So there's 2 kinds of dollar cost averaging. There's doubling down and there's pyramiding. They don't double down, they pyramid. The problem with doubling down is it leads to bigger losses, which can lead to blowing up. Pyramiding plays with open profit and risks giving it back, but pyramiding allows you to get really big winning trades. So what they would do is so they can pyramid up to 5 times Okay, it sounds like sometimes they started with half an ATR stop on the first day, and then every ATR moved in their favor. They pyramided, and they would do it 5 times. And every time they advanced their stop, they'd have it 2 ATR back. So they'd end up with like a 5x position potentially, and it might stop out and it's not a win, but sometimes it just keeps running and you have these massive wins. So I found it to be true in backtesting. Adding to winners is really good. And then the last thing is risk, I suppose. They talk about risk of ruin. So, okay, for every 10% in drawdown in their account, they cut their trading unit risk by 20%. So every time that they lost, their equity would go down, they would reduce their trading size. The flip side is that as things went their way, they could increase their risk. So this is how they're able to get like 100% annual returns, is they just built and added. That said, that rule of cutting the risk by X% on Y drawdown was derived from a max historical backtest rating of saying we don't want to draw down by more than, I can't remember what the number was. I think it was 80%. It was like super wide or something like that. Although there's a little bit of controversy in this study where some of the turtles did a computer backtest and it took them like a year to do. And they found that there was a problem in the original computer backtest and that the risk of ruin was much higher and they had to cut everybody's size in half. So, and then they didn't perform as well from then on because they were trading much less size. But that also just goes to show how hard it was back in the day. Nowadays, you can use ChatGPT or Grok potentially and get it backtested in an hour. And back then, it took a team of smart people a year. So, but now, even though you can do it, other people can do it too, and it's a super competitive world. But yeah, I mean, my MTP system is based on the same principles of long only trend following on the best assets, buy breakouts, although I like to buy dips too. Dip is a front run to buy other people buying breakouts. It's also a way to differentiate. And I believe you can buy dips on if you select the right asset, but it's less about entry, it's more about trade management. Run a wide stop based on ATR, pyramid to winners, have a couple conditional closes, and just stay with the trade until things turn around. So hope you find it useful. If you're interested in our systems, the MTP Market Timing Pro system, there's a link to it down below. That trades a similar system to the turtles, and the crypto bots actually have long only trend following on Bitcoin built into them. So to help balance the portfolio, it's one of the things they do. So there's a link down below. Go check it out. Appreciate y'all. Much love. Talk to y'all soon. Peace.